All righty. Good morning, everybody. Good morning, and welcome to the Hurley Investments Trade Findings and Adjustments of June 30th, 2022. This morning, I really just wanted to give a bit of an update on what we're doing in accounts and just see if we can't take a look at things and see where the market might get down to. Going back to a couple weeks ago. This is kind of old information and not necessarily useful, but a couple weeks ago we talked about a couple things. Trade of adding a QQQ put. If you'd put that on, it'd probably look pretty crappy until today. Talked about what it really means to have a recession, which is just defined by 2 consecutive quarters of negative GDP, and the fact that we haven't gotten that yet, even with how crazy inflation has gotten, as well as how much interest rates have come up. But of course, the fear is what that will all cause in the future, in the near future, if those things don't get taken care of. None of that has changed. So again, this was a couple weeks ago where I was talking about adding extra puts through this mess right here. We had gotten protection on pretty much everything by June 8th before this incredible fall, which was awesome. Around these couple days, started to add additional puts for positions, which looked good for a couple days until things started to head back up. We took those off and then booked some great profits on the rest of our puts as the market started to look like it was having a bit of a bounce in here last week. And then on Tuesday, looked like we're having a reversal in our market, so we started to get some protection back on, based on what some of our stocks were doing. A lot of them look similar to this Disney chart, where had a low and a bounce coming higher up to a pivot point where we had a big drop and started to see several of our stocks come down. So just trying to follow where the market is going. I would have liked to see it really bounce up closer to the 50-day on a lot of these charts. We never really got that, and we didn't get that last time up here where market topped out around 42, 41.50. So because of that, and today we got more bad inflation numbers, which means higher likelihood of some more aggressive rate hikes coming forward. Next month, mid-July, of course, we have another Fed meeting, which is where we'll look to, I guess that we're now looking to have everything protected for that event, especially if it comes in as a 75 basis point rate hike. That will most likely cause the market to fall off a bit more. So I think that it's really more expecting a 50 basis point hike. So with that, what are some of your questions? And what can I maybe go over for you as I write some of the stuff I just said down? Any thoughts or questions, guys? This is why I'm here, trying to answer some of your thoughts or questions. I shouldn't say that we're looking to have protection on, because as of this morning, we've got everything protected once again. A little bit on the QQQ puts. If you did that again, I would suggest you keep those on. If not, at this point is kind of a crapshoot right now. So I don't know that I would try and put it on now. You might look at a 280 QQQ put out for a month, over a little over a month if you can afford it, to see if we get down to 270. But let's be honest, there's just, the market has just been everywhere, and especially the QQQ ETF that follows the NASDAQ. You're really just guessing and having it on there for portfolio protection if you have a bunch of leap calls and maybe not so much shares, or you have a bunch of, you know, shorter option trades that that you'd like to just hedge your portfolio. That's what I might do. You could also look at the SPY, but they're probably going to be a bit more expensive as it's more expensively priced. ETF up at 377 as opposed to 280 on the other one, but it's also not quite as volatile, so you might not be paying for so much of that volatility premium. Just kind of up to you. Any thoughts or questions on that? All right, Jeff asked, how much more do you think we're going to go down? Actually, I appreciate that question, Jeff, because that was what I was planning on going over next. So let's take a look. This chart is, of course, last 6 months, which obviously doesn't help us. So we need to go a little further. This one goes out 3 years, which is kind of a lot, but let's take a look at what it has for us, get an idea. So this is 2020. Our lows were all the way down. You can see this tiny little red line right here. We had that one day where in March that it was just awful, and that was about 2,200. So we're definitely way far off from that. I wouldn't expect to get down there anytime soon. So let's look at maybe some other spots. So you see this pivot point right here. It's close to 3,500. It's actually, let's see, 3586. You can see it right here. It shows our pivot points, 3586. You come back end of 2020, and it had topped out there a couple times. 1, 2, let me draw a little bit for you guys to see. 1, 2. That's also close to this bottom we had a couple weeks ago, back here. And that bottom was at intraday. You can kind of see both of these about the same level. The low there, that L, you can see tells us our low for that day was 36.36. Still had a ways to go to get to 35.80, 35.90, or I guess it's 35.86. Again, where that pivot point is near term, that's where I think we can get down to in the next couple days, if not weeks. Yes, and where's my ampersand? Oops, there we go. 35.86, which is again pretty close to that high level on 2020. In 2021, we've pretty much all given up most of 2021. So that's not going to help us. Next spot down, I'd say pretty close to this 3,200 level. A couple times it got close here. Had a half a month here where it used that as a base. Back in June 2020, topped out for a month, couldn't get above that. So that would be my, when I'm running out of batteries here quickly, just in the nick of time. Whew. All right. So what would I say is the next leg down? We talked about 35.86. You could probably make an excuse for 35.50. I'd say the next leg down would be 3,200. Would be the next big leg down. Then it's going to be 3,000. Obviously, just a big round number. It's going to be a huge point of support, I would think. Next is going to be a couple hundred down. You see that for a month here. Market kind of traded in that range off of 28. Could actually make an excuse here for 34, just because this was the high of 2020 before that big drop. But I feel like it's so close to these other ones that it really is kind of irrelevant. The next place really is 23 or 2,200. And I'll just put those are where we can get down, just base it off of past history. It doesn't mean we will get down there. I think the likeliest bottom, if we continue to have inflation that just doesn't let up, is going to be around 3,000, because it's a round number. But that's pretty much it. Those are my numbers. I guess we kind of always want to know where things are going to go and what's going to happen, but it kind of goes without saying, although I feel like I need to say it a lot. We can't predict the future. Even if inflation continues to go up, it's still going to be the market's expectation. Their trading negative will be because of the expectation that inflation will hurt the economy. And while it is starting to kind of show that, everybody's kind of upset, pissed off about it, pissed off about gas prices. Again, we still need a couple quarters of a negative GDP to really show that the economy is struggling, and we haven't got really anywhere near that yet. We've had one quarter, I think it was actually even just a month, of a negative number. But I will say, if we do get those consecutive quarters of negative GDP, that's where we're going to get a sell-off that gets us down to this 3,000 level or more. And another question from Jeff. You might have said this before, but what do you use to gauge to get into puts, and what do you use when to get out of puts? A couple things. Does anyone want to help me answer this question for Jeff? And yes, Jeff, we use technicals. So a few things, and I wanted to see if anyone would want to contribute to this, answering this question. So I'd say the biggest thing, Jeff, would be future events. The main driver for that is going to be earnings reports. Put a number one because that is our main reason for protecting, because our stocks can move 20% one way or the other in the 2 weeks before and after an earnings event. So we'll get protection on at least a couple weeks, hopefully, before earnings reports. Sometimes if a stock is having a pre-earnings run, we'll wait to add protection until it might hit a resistance level, and then we get protection on. But typically, we're trying to go out a couple weeks. We're trying to go out, protect a couple weeks before an earnings report, just because within that 2-week period, you start to get higher volatility, which causes your puts to be more expensive. Another future event I already mentioned, economic reports. So currently we're looking to have protection on for our July rate hike decision by the Fed, because we're expecting a rate hike and because it might be more aggressive of a rate hike than maybe the market might be expecting. Sometimes certain reports are not important, but this is an obvious one where this is one of the things that the market is really clued into, which is inflation and the Fed's reaction to inflation, which is their hiking schedule, rate hiking schedule, and all of the stuff that they say on those Fed meetings. So because it's such a hot issue right now, that's one we're looking for. In previous years and other times, it wasn't important because inflation was low and there was no event that was worrying anyone about rising inflation or rising rate hikes. For the last several years, we had easy money policy where the Fed was buying up junk bonds and all sorts of securities, like they did for 2008, 2009 for the housing market crash. They bought up MBS's mortgage securities, mortgage-backed securities. So this one really just depends on the current time. We're not going to protect for every economic report number that is going to come out, but use some judgment to decide which one we might need to protect for. So that's one. I mentioned that. What else? Yes, we use technicals. You know, I'm going to do technicals last because that's really if we don't have anything else more important. So this is just if and this will go along with technicals, but a surprise news announcement like let's say a CEO dies suddenly, and Disney's CEO dies, and then the stock starting to fall because that just makes everybody worry. And let's say it's starting to fall, but it's holding a support level. We might choose to wait to add protection, but if it's breaking through those support levels, we're going to be looking to get protection on until that news either resolves or cools off, or the stock finds a bottom. Right, CEO falls out of a helicopter. Exactly my point, Jeff. What else? So basically every morning I'm looking through major headlines, news announcements, stock specific news that's coming up that might be influencing where a stock is moving. That's just kind of a daily thing that we're on top of, so that we know what's going on and we can make decisions based off of whether the news is silly, overblown, or really has some merit. And we just make decisions based on that. And that kind of takes a little more experience and understanding of the fundamentals. And so this one kind of goes along with it. So fundamentals change. Let's say this kind of also goes along with an earnings report. If they missed big on our earnings and there's having supply chain issues and there's all these issues that's preventing them from having good earnings reports in the future, this is going to affect our fundamentals because they're not going to be able to make as much money, etc. So a fundamentals change, and that might not be on an earnings report. It might be part of a news announcement, like Boeing's planes crashing and having to deal with that. So that will be a fundamentals change along with the surprise news announcement. And we kind of go over what I just said before, look at technicals, see where support levels, resistance levels are. So that brings us to technicals. Let me get to that question in a second, Jeff. Here's my example. So back here, Disney falling below this pivot point, that's a support level, or it's both, right? If it's can't hold above it, it's a resistance level. If it's holding up below it, it's holding above it, that's a support level. These pivot points give us an idea for a short-term support level. This 50-day moving average gives us an idea for a moving support and resistance level, as well as this longer 200-day moving average. You can see a few times where Disney tried to get above this 50-day and could not. That tells us there might be a reason for protecting, or if we had already protected, we wouldn't be taking off protection until it confirmed that it could get above that resistance level. On this one, we might have seen this as a support level on this pivot point, where a few days where it was holding there and then starting to bounce again. We might have booked a protection, booked profit on protection. On this one, we're looking at it falling, not being able to hold this day on June 8th above a pivot point, and some other more bad news coming in that kind of coincides with that. We were able to get protection on a Disney on this day before it really fell, before around our rate hike decision this week. On this week, not literally this week, but this week I'm showing you. So your other question, after the open events, how do you handle puts at the money? So let me answer that after I say, so our technicals looking for support and resistance levels. And also technical crossovers. So let's see. So this chart, you can see these red and blue lines are a little closer moving to the stock. You go back here and you see these ones way out here. These are different moving averages. So I'll go to Disney and you can kind of see what I'm talking about again. So the red is 20-day exponential moving average. The blue is a 5-day exponential moving average. Exponential just makes it kind of move quicker. And if we're getting a crossover one way or the other, that signals a bullish or a bearish run. You can see it tried to cross over here and didn't. So we never could get bullish on Disney. And anytime we're in the 5-day under the 20-day, that is a bearish indicator. This MACD right here, if we cross over this middle line down here, that's another indicator that it's bearish or bullish or moving, changing direction. You see it here moving down. This is crossing over or really can't cross over to the bullish side. This is our RSI. This tells us whether a stock is overbought or oversold. If it gives above this 70 line, it's overbought. If it goes below this 30 line, it's oversold. So if it crosses the middle line, like it did over here, it shows us that we're crossing over all three areas. We got a crossover again right here, right here, right here. This is telling us that the stock is technically bearish when we get all three, and the opposite if it crosses over to the positive side. That means it is bullish. So that's something we'll look at to confirm, a change in direction, or to decide if a stock is technically bullish or technically bearish. As far as what to buy on puts, yes, it's going to be at the money, typically, or the closest one. If it's below a strike, the closest strike price. So for example, Disney this morning, it was close to, it was like 93 something. And I think the next closest one was 94 or 95, something like that. So I had to go a little bit in the money. Typically, I like to go a little in the money just to be a little more protective. But that's just me. So did I answer your questions sufficiently, Jeff? Kind of went into some of the big basics of what we're doing. All right, guys, so any other thoughts or questions? And again, Jeff, did I get the questions that you had answered? Hopefully, not hearing from you. So I'm gonna assume I did and you're just not able to answer at the moment. Yes, what is a pivot? It's just another indicator that plots out every new month what our likely support and resistance levels are. And on this stock chart site, it would just be right here under pivot points. And it's just something that we've seen that to some good degree plots out a good estimation of where a support or resistance level might be. You can kind of see where the stocks stop and try to hold on to and move, break below. Some of them don't look like they help at all, but a lot of the times they do. All right, guys, I think that does it for me. Thanks for joining me this morning. Thanks for all of the questions. I'll get this posted, and you'll have all of this information posted on our website, our blog site, which is this My Hurley Investment singular.com. Up here, myhurleyinvestment.com has all of our stuff that we post every week. So go check that out. That does it for me. You guys have a good weekend. Hang in there. Try and be protective, but also nimble in case we get things starting to bounce again. You can see Disney hitting this 92 level, and it wants to maybe look to find us a good support there. It's just a game of waiting and seeing and trying to confirm a direction change or confirm a support level. Stop trying to pretend that you can outguess the market and guess the future. You can't, so stop trying. And that's it. Take care, guys.